What's happening, guys? Welcome into the channel. This is episode, I didn't look before we started, Zach. I think it's 46. We'll go with 46. We got a good one today because we are getting away from election. We're getting away from interest rates. We're getting away from the Fed cut. We're getting away from the fact that rates have been going up pretty steadily for the last 5 weeks. We're kind of setting all that to the side, and let's refocus on something called pre-qualification, pre-approval, and why that's so important, and how that actually helps you from a rising rate environment and in a lowering rate environment. We're going to discuss both of those angles. So I'm Chad Anderson. That guy is Zach Jones. Zach, everybody always, one of those things that says, are you pre-qualified? Are you pre-approved? And I do feel like, you tell me this, I feel like this message has gotten more and more solidified and carries more merit now. I remember 5-10 years ago, there were agents who would still run people around in their cars and they don't even have a pre-qual letter. They haven't talked to anybody.
Yeah.
They were kind of so desperate for a deal, they didn't care. They would just say, yep, let's go. All right, I'm not going to rock the boat. I'm going to just roll the dice, trust you that you're good. And we're going to go over here. We're going to look at all these houses that you want, those kinds of things. And then come to find out, it all blows up in their face. I feel like that has shifted to where I find it now very rare that anybody would be allowed to go out without a pre-qual or pre-approval. You kind of seen that, or am I living in my own bubble here?
No, I think that that's true. I am aware that there's probably a strategy for, you think about it, Chad, we all have instincts that we develop in business about clients and customers. And, I can get on the phone with somebody, not even have them in front of me, and just start conversationally getting to know them a little bit, and a profile develops. You find out what they do, and you find out where they live, and a little bit about their family, and then suddenly you've got this idea in their mind that they're the 780 borrower. They've got 25 or 30% down. They're going to be a low credit, low consumer credit utilizing kind of client, or maybe some things give you some impressions on the opposite side. And I think that real estate agents develop those same instincts, and that there are clients who probably need to have a carrot out there on the stick before you go too deeply into the pre-qualification. They say, oh no, I haven't talked to a mortgage lender. I'm good for it. I bought, 3 houses before and I've got 800 credit, but we need to go see 123 Maple Street this afternoon. And you go ahead and you take them, meet them over there, get that carrot, get them salivating a little bit, and then do that. But for the most part, and I think that the recent regulation changes where you have to have some agreements in place to show a home have created a more formal approach between agents and their prospective clients, especially buyer clients, to have your ducks a little bit more in a row about the pre-qualification, pre-approval process. And then, let's talk about the elephant in the room. What about the elimination of agents that aren't doing business, or, the agents who don't have as much experience under their belt? It's those more seasoned agents that are going to say, 1, 2, 3, this is what we need to do, get it done. And then we'll get out and see those houses. All of those things come together to say there's more pre-qualifications before people, cross the threshold of a house for sale.
And as someone who has sold a house recently, I can tell you, I would get legitimately pissed if someone was trying to come see the house without proof of funds, some sort of pre-approval. But in my world, and I'm just telling you from the seller side, and I know everybody's different, but for our lives, we have 3 boys, all 8 and younger, and we have 2 dogs. The process of getting your house to the point of showable and presentable and cleaning it up. And then you got to remember too, you have 3 children and 2 dogs. They don't understand really what is going on other than, hey, go pile up in the Tahoe because we have to go drive in circles for 30 minutes.
Right.
And that's a big deal. And you may not think about it, but unless your house is one that sells instantly, mine didn't, then it's a situation where, hey, you got to do this more than once. You got to do it over and over and over.
Right.
And when somebody is coming in without the pre-qual or the pre-approval, we wouldn't even let them. But if you get that situation where somebody comes in and it's like, well, they have this or they have that, or they want to do this, well, here's why. It makes a difference. And it can turn a seller pretty sour fast. And so if you're in a spot where you're the buyer and you're wanting this house, then it kind of gets off to the wrong foot, when you get started. The only exception, and you kind of alluded to it, is, and I don't think there really should be any exceptions, but if you were going to make one, the only one I would say where I could buy in a little bit is they're a third time repeat customer. I know these people,
Right.
I'm not like best friends with them, but we stay in contact because I helped them with 2 other houses. I kind of know their lifestyle. I know some of this stuff. So unless there's some deep, dark secret going on that just isn't publicized or out there for public viewing, these people are gold.
Right.
And I could see that. Now, you still obviously run the risk of that small variable that, it does blow up because you didn't know that they're actually getting divorced or that they co-signed for 2 of their kids and they didn't think it was a big deal or something like that. But still, that's about the only one that I would say like, all right, I kind of get it.
Right.
So walk us through, Zach, pre-qual, pre-approval, process differences, what it looks like, and then we'll get into rising and lowering rate environments.
Well, and this may be, you may need to enhance my explanation of my process because yours may be different.
It'll be different with everyone. That's a great
Yeah.
point. So this could
People
be
make a distinction between pre-qualification and pre-approval. I do not, because I think that pre-qualification is the lesser of those in terms of intensity and documentation and all of the supporting details. Where pre-approval is something that we've gathered all of the necessary documentation that is critical for the loan and run it through at least an automated underwriting system, and maybe even put the file in front of an underwriter for a scenario approval. That before you get a letter from me, we're going all the way to that point where I don't have any doubts about the fact that we're going to get to the closing table once you get under contract. As long as you don't change something for the worse, we're going to get to the closing table. So my pre-qual is always a pre-approval.
Yeah, just real quick on that too, to add to that. I think even agents, it's not their fault. They just don't completely understand sometimes. All lenders are different as well, because you could sometimes they'll say, well, has it been to an underwriter yet? That, to be honest, really doesn't mean a ton. And the reason I say that is there are so many things that can still blow up after an underwriter sees the file for the first time. So I'm talking about, there could be a conditional approval, right? So yes, it went to the underwriter, because I'm just differentiating your pre-approval versus what some say, I want the underwriter's approval.
Right.
But still, think about it this way. Well, if we had every single tiny little piece of documentation on the first submission, well, then we'd be clear to close after the first submission.
Right.
That's why you have a conditional approval and then a final approval. And my point is, an underwriter has to make a decision. And when they do, they'll come back and say, hey, income is good. I'm going to go ahead and approve it, but I need this clarified by the employer, and I need this clarified by the borrower, and I need to see one other thing for the income validation. I think we're good, but I do need this to kind of finalize the income. And if those things come back, like, there is the potential that it throws everything sideways, a little later in the process. That's never anyone's goal. But from a pre-approval standpoint, I wanted to kind of differentiate, because I do what Zach said, and that is gather the docs. I review it. I've been doing this long enough. I have an extremely low fallout rate, just like Zach does. And when we look at these things, we're putting our name on the line and we're good. But that doesn't mean it's ironclad. And some people want that underwriter review. And I think sometimes people don't realize, hey, things can still go wrong after the underwriter sees it. So it's not like it's completely smooth sailing after that point.
Another way to kind of conceptualize that, maybe, and I think that this is part of what you were trying to say, is that if we do a pre-approval that's good enough to do a letter, and it doesn't go to an underwriter, in my world, that's as good as it has gone to an underwriter. The only things that could go wrong would not be detected on an initial underwrite or my pre-approval. And sometimes we'll take those files that are they've got a lot of hair on them. There's concerns, there's multiple layers of this and that, and how's the income going to work, and can we roll this in, and is this going to part of it going to work? And those will go to a scenario review, and then we know. Then I can take the conditions that come back to the borrower and say, hey, listen, in order for this to work, we've got to do A, B, and C. And then we document that, and we're able to substantiate those things. Then we're as good as we can be without, something that comes up. And Chad, we're talking about the rare exception that something comes up later on in the game where we figure out in the property checks for the background check that somebody owns, 7 lots somewhere that they inherited, and they, have a bunch of taxes and insurance, and it throws them out. But they just, I didn't even think about that, because that's old granny's lots that are, off in, rural Ohio somewhere. I did have that scenario one time, and it threw a wrench into the works late in the game because nobody thought to mention it. So
you always say it so much easier and better than I do. So thanks
I
for
don't know
helping.
about that. So the pre-approval process, once it's done, really is kind of maybe it's a loan in the starting blocks, and like at a track meet or something. And when we fold the property into it, we've got a property contract. Then we're launching it and moving it down the road. That's the time that we pull the trigger on it. And a pre-approval, I get this question a lot. Well, how long does a pre-approval last? In the world in general, the easy answer to this is that a pre-approval lasts in its original form as long as the credit report is good, which is 120 days. So you got 4 months to close on that credit report.
Yeah.
Once that credit report expires, all we have to do to bring the phoenix from the ashes to revitalize that pre-approval is pull another credit report. Now, you've got different scores, so that could affect, how the loan prices. You might have a little bit different credit profile. The usage is up or usage is down. So now we have to, mind our debt ratios a little bit and kind of do some refiguring on that. But as long as the borrower does not change anything about their qualifying details in a negative way, as long as they stay the same or get better with income, assets, and debt, then a pre-approval just kind of keeps going until there's always the possibility down the road, a year or two, that a loan guideline changes. Or I was just talking earlier about an income scenario where there's a continuance of income that no longer meets the 3-year requirement.
Yep.
Then that person gets kicked out of qualifying. So there are some long-term things that could happen. But that's just a matter of, staying in touch and being conversational about, hey, where are we? I know that I fell off of looking for a house for 6 months. We just got exhausted. Now we're firing back up again. What's the status? Well, let me pull your credit again. How's everything with the job? Anything different on this or that or this or that? Okay, we're good. And you keep going. Well, and so we'll get into, there's another piece of that with rising and falling rates, but we'll get into that.
Yeah. So all good stuff. The pre-qualification process. Also, I have found how crazy easy it is compared to 10 years ago, for sure. I would say even 5 years ago, because so many things can now be validated so instantly, right?
Mm-hmm.
Like credit's instant, that's an easy one. That's been that way for a while. But on top of that, we now have things like verification of employment. And it's been around, but it's just gotten easier and easier. It went from handwritten forms to sometimes it would validate on services of the third party like Equifax or the Work Number, to now it's just the click of a button where you can order it within seconds. And I can have all your work history, all your salary info, your bonus, your commission, your overtime, whatever you got. And it's based on what the employer is reporting, but we can at least pull it right then and there, which actually makes it to where, think about this. If you called me up right now, Zach, and said, hey, I want to get a house. Well, depending on where you worked And if those companies reported to one of those third-party vendors, you could literally do a credit app. We could have credit in 90 seconds. Then you could click a couple of buttons and have income verified. Like if you worked for Nissan, you have income verified. Then you go to assets. Well, there's a way to log in and have your assets linked to your application where you don't
Yep.
even have to do the PDF email or upload to a portal. It just comes in. So many times in today's world, people think, oh, I got to go get pre-qualified and I got to scoop up all this stuff and that stuff and whatever. And that still pertains to some people, depending on what your situation is. But there are also scenarios where I could have credit, income, assets, and an automated approval in under 10 minutes.
Mm-hmm.
I think that blows people's minds because when they hear, just like it's finally shifted to where I truly believe more people are getting pre-qualified, pre-approved before they go look at houses. I think we're still in the middle of that shift where people don't realize how easy and quick it can be and how
Right.
it can be done in 10, 15, 20 minutes,
Yeah.
depending on you and your computer ability and our availability of being at a computer at that specific time. But you can have all that and be literally pre-approved because it's all documented digitally. So
Yep.
the point there is let technology work for you. We kind of made the joke on this show in previous episodes where we say, hey, you know what? Remember you used to be that guy where you were the weirdo if you put your credit card info in on PayPal? Well, now you're the weirdo if your credit card's not on your computer somewhere or on your Apple Wallet or your phone or something like
Right.
that. I mean, that's kind of where we are now. It's like transitioning to, hey, it's just getting easier and easier to document stuff, verify, and validate. And so pre-approvals and pre-qualifications, moral of this quick story is don't be scared of them. They're actually very quick and simple. Can be. Now, again, if your company doesn't do that or your bank doesn't do that, then okay, it could take 30 or 45 minutes. But it's all still pretty quick and easy, nothing that takes like days. Unless
Right.
you're in a borderline situation where Zack and I are sitting here going, you know what? I think I can help you, but I want a little more validation that my brain's on the right track for you before I overpromise and underdeliver in those.
Right. There's
All
still
right.
still those harder deals out there that are a little bit
Yeah.
hairier, but yeah.
Yep. So let's talk about for the next few minutes just the purpose here and the good and the bad on getting pre-qualified, and then how that ties in to rising rate environment and lower rate environment. Because there's been so much volatility, Zach, over the last 2 years, and especially over the last 9, 10 months from
Mhm.
Q4 of last year to
Yep.
late October this year. It's kind of wild. So what would you say are some of those, as far as impact and what it means in a rising rate environment, and then vice versa on the low side?
Yeah, let me. I want to just one thing that popped into my mind that you and I don't know that we've ever talked about this, but it popped in when you were saying what you were saying. I think that I want to say just a quick word about hard pull versus soft pull with credit, because that's a part
Yeah.
of the pre-qualification process. And I get a lot of people asking about it. Had it yesterday. Was this a hard pull or is it a soft pull?
Mhm.
Personally, I always do hard pulls unless we're like really, really just kicking tires and we're 6 months out and I don't, my rent lease doesn't expire until next August. Well, I might do a soft pull. Um, I'm a hard pull guy because I want information from all three bureaus. I want to see all the debts. I had one loan scenario, had to have been 15 or 18 years ago, that really taught me a lesson about the discrepancy in reporting between bureaus. It was like the freakiest credit report that I'd ever pulled in my life. And it just kind of cut a groove in my brain that was like, we need all of that information. So do not be scared of hard pulls. Soft pulls are a little bit suspicious to me because we don't have all of the information from all the bureaus, and sometimes there can be a really bad credit reporting that goes only to one bureau, and that doesn't come up on a soft pull.
Yeah.
Hard pulls might pull, you know, 3 to 7 points down on your credit scores, but those recover relatively quickly. 45 to 60 days, you ought to get those points back. You're going to see more variation for charging, a TV on your Visa card than you typically would for a hard pull. That's my those are my words on that.
It's a good point. Soft pull, the only reason or a couple of reasons I like it is, one, if we think credit's borderline. If you're up front, just say, like, I don't know, then okay, fine. Let's take a look at the soft pull and just check and see where we're at, and kind of go from there. The other thing is, on a soft pull versus hard pull, if you're not under contract at the moment, soft pulls aren't bad. This could be an entirely other episode, but because you get subject to trigger leads and you become a trigger lead, and then you get blown up with phone calls, text messages, emails about mortgage rates and shopping, and we want to call you and talk about
very
this.
confusing, right?
Yeah, it's so annoying and frustrating, and it just sucks, to be honest. And they do it post closing too. There are plenty of mortgage scams that we've talked about on previous episodes, but the soft pull there, it doesn't prevent the trigger leads. We can do that another day, as far as like a way to maybe slow those down. But the soft pull at least delays the trigger leads for when you're going to come in and actually buy something. So that's about the only 2 times that I ever use it. Otherwise, I'm with you. I'm pretty much, let's go ahead and get the whole picture and make sure we get everything lined up.
Okay. So back to the variation or the volatility in a market for a pre-qualification. Chad, if I take a mortgage application from you and I pre-qualify you for the loan scenario, maximum thing, purchase price that you feel like you're going to be happy to afford in terms of the monthly payment, and we qualify you at 6%, then you go out and you start looking, and you're looking around. Maybe you get tired of looking, maybe you get distracted, maybe you have a job change, and so that takes you off of that trail. You get oriented to your new job, you roll back in 4 months later, and now rates are at 7%.
Yeah,
that's going to be a situation where if you were tight on your ratios at 6%, then the pre-qualification is no longer is as valid as it was, because you might actually be knocked out in terms of debt ratios, and we may have to adjust your purchase price a little bit to accommodate that, because a full percent in interest rate could knock you out. On the opposite side of things, if the same scenario happened and we were pre-qualified at 6%, and you come back into the market and start looking at 5%, then now your payment is going to go down pretty significantly, and you might actually be able to qualify for more. So I think it's important in the pre-qualification, pre-approval process to be cognizant and have conversations about where rates are. Especially, we've been so volatile in the last 2 weeks. I don't know.
crazy.
I'm sure that we've seen as significant a rise in rates as we've had in the last 2 weeks, but they are rare. And by the time you see this on YouTube, rates might be down lower than they've been in the last 24 to 36 months. But it's important to keep an eye on that, because it does affect the pre-approval process.
And
your expectations for your monthly payment, most importantly, that's
I just looked, and in 18 days, Zach, so since October the 3rd, okay, mortgage rates have worsened, okay, gone up. And again, this is not the rate itself, it's the cost of the rate, meaning that if you were quoted 6% with no discount points 18 days ago, well, today you would have a 6% interest rate, but you would have to pay 183 basis points, which is 1.83% of the loan amount, which I use 400,000 a lot. So at 400,000, that's looking at about $7,200, a little bit north of 7,200 that you would have to pay to get that same thing. That's how much it changed in 18 days.
Talk about that in rate. Because we always talk about
it's hard because it jumps around, with the coupons and stuff. But
Right.
I would say if you're looking at it, like just say half of it. So it went up 7/8. So
Yeah.
like if it was 6 with no points, it's now 675, 6.8, something like that. And then you
Yeah.
translate that to monthly payment. Well, it's about in that price range, what, 30, $35 per eighth, somewhere in there, $35 per eighth of a percent. So you do that times 6 or 7. I mean, 6 would be $210. So you're looking at a 2 to 250 increase in your mortgage payment in
On
18 days.
a median priced house in Middle
Right.
Tennessee. So
Correct. And so to put that even in further context, if your debt ratio is 48%, but we were good, like still got 2% spare room, right? But now it goes up to 40 a month on the payment. Well, now guess what? You're over 50% potentially.
now, or maybe you're not, but we don't have any more wiggle room. We don't have that
Yeah.
2% to adjust for higher taxes, or
Or your
you know,
income being barely overstated by
right,
$80 a
right,
month
right.
or
Yeah,
something like that. Yeah.
you got
Little
blown out of. That's the world we live in. Is these, oh man, I'm $12 off. I got to call the insurance guy and see if we can get the premium down by $150 a year, and then we can qualify again. We do that.
Yeah, it's pretty wild, man. Like how close, and I get it. Somebody will come to me all the time. I'm sure you get this too. They say, "I've never missed a house payment. My credit's 800. I can't believe that I don't qualify now because rates went up 1/4% and blah
Right.
blah." And it's like, look, we can fix it because we can do some things with the insurance, or maybe you have to spend a little extra money and buy down the rate 1/8%, and it just costs more and it sucks, but it is what it is. Like Zack and I are not going to let a loan die just because we couldn't figure out $50 a month too much in the puzzle.
Right.
But it is an impact. And these things do happen. And there have been times it's, come up before where you go, look, we've exhausted this and you're still 0.5% too high on your debt ratio, not the rate, but the debt ratio. You got to go talk to family. You got to get a gift. You got to pay something off. You got to draw more money off your 401k. You
Yep.
you just got to do something you don't want to do, and it's because of volatility like this that we've seen. But as you said, there are some good things about it if rates decide to take a tumble.
Right. Right. So, and because that gives you a little bit more buying power when you get to the when you get to the contract point, and or you just have a better monthly payment, and everybody's looking for a lower monthly payment these days on
Yeah.
everything that they've got
Right.
index.
Or you get the house and you thought payment was going to be 3 grand, and luckily enough, it's only 2,800.
Yeah.
And
Yeah.
hey, good, good luck for you. That's all there is to it. No, nobody watched the market, nobody timed it, and zoomed in on it and nailed it on the perfect day. But sometimes luck is on your side, and that's how it works out. So those are always a little easier phone calls to make than the ones we've had to make over the last 2 weeks, right?
Yeah. Good surprises, right? Good
Yeah,
surprises.
yeah. Anything else on this before we wrap up? Pre-quals, pre-approvals, rising,
So,
lowering rates.
so what do you think? Summarize. What's the most important thing about getting and maintaining a pre-approval?
Well, getting it is by far number one. And then I can't believe this. I've had clients come to me who talk to other mortgage people first. And they're like, I didn't know what my payment was going to be. I didn't know what my closing costs were going to be. I didn't know
Unbelievable,
that
right?
my cash to close was going to be. So it's like, well, that's all pretty easy. Now I'm ballparking, but it's all in good faith. I'm not lying to you. I'm just going off the information we have. And we just kind of break it out into buckets and say, down payment you have to bring, or it has to be a gift. Closing costs can be you or the seller up to a certain amount, depending on the loan and the situation. And then payment, I'm like, I can guarantee you the principal and interest calculation. I have no idea what the taxes are going to be. I can ballpark it, give you a good guess. Insurance is the same. But I have people who are blindsided sometimes by the payment or the cost. And to me, that's asinine. So Pre-approval, pre-qual, whatever you want to call it, crucial. That's number one. Know your payment. Make sure you're comfortable with it. Know your cash to close, the good and the bad, both ends of the spectrum. And then I always say too, like on these things, know your debt ratio. And I'm not saying know it in the sense of how to calculate it. If you want to, I'll show you. But I'm not saying you need to. You just need to know the number. Because if rates start going up or you see them going up, or there was a house you loved and you see them coming down, you just need to know how tight it is. Like, is this a slam dunk? Is this one going to be
Right.
close? Are market changes going to impact me buying a house? Like, where do I sit on the scale? How close is it? Those things are all crucial to know, because otherwise, quick story. I have a first-time home buyer. I feel terrible for her. Couldn't find a house she wants. Went to the seller. This was a month ago. Said, I really want to buy your house, but I don't have any money. I'm using this program. I need some help. If you're motivated, I'm willing to work with you. This is all I can afford, though. And I was talking to the realtor about it. That seller didn't want to budge. Had only been on the market a week or two. Okay, I get it. Here we are a month later. The seller is now calling us back. Hey, we're willing to talk.
I know the end of this story, right?
Problem. Rates for her are literally, because it's a DPA program, literally a point higher now.
Yep.
Than what we could have gotten her 4 weeks ago.
Yep.
She still barely qualifies, but the payment is now $250 more than what she wanted to pay.
And she's a lower income person, I'm sure, doing a DPA. So $200 a month is not something that she can find like somebody who's, making $120,000 a year. She can find that family can find $200 a month, right?
$250. And this person is so sweet. I love her to death. I really hope it works for her in some way, shape, or form, because I want her to get a house. But $250 does actually impact her life.
Yeah.
Like, there are plenty of people who live in $250. You don't want to give it away. You don't want to lose it. You would take a $3,000 a year raise right now, but it doesn't change your life necessarily or prevent you from doing one thing or the other daily. $250 to her is a big, big deal.
Yeah. Yeah.
And the market swallowed her up because that seller didn't want to do anything. And now that seller's in a tough spot because they didn't get an offer. They haven't sold it. We're 30 days later, and now guess what? Rates are higher. So now everybody's looking at that house like, I don't really, we'll just wait.
Everybody lost in that deal because of hesitation, maybe a little bit of greed, maybe a little bit of being pinched on ratios and budget. It was all a combination. Like both sides kind of came together and said, gosh, it's not going to work now. Well, 4 weeks later, maybe we can work it out now? No, because the market was that magical factor that came in and crushed it.
Yeah. Well, every point drops, 8 million people come into the market. So
that's that in a market that only sells 4 million houses a year.
How is it that when rates go up, 8 million people don't leave the housing market, but when rates go down, the whole country of China could buy a house in the U.S. at that point? It's unbelievable. But yeah, that's all I would say. If you quickly summarize as well.
Communication, man. Number one, I've said don't be afraid of hard credit pulls. Don't be afraid of a pre-qualification. It's just an application. We're trying to figure out. We're trying to figure out where you land. I'm not gonna be calling you every 3 days asking you how your house hunt is going along. So do the pre-qualification, figure out where you stand, and then continue to communicate. And part of that is that this whole discussion about $200 for the person who has reasonable debt ratios and makes a good living. I wouldn't let $200 a month swing in your monthly mortgage payment keep you from buying the dream home. Find it somewhere else. Eat out less, fewer, stops at the Chick-fil-A drive-through after baseball practice. I'm picking on you directly,
I was
Chad.
going to say, was that a shot? I mean,
Oh man, I got real close on that one, didn't I?
guy loves a cookies and cream milkshake. We're going to get hell for it. I mean,
So you
that's
cut
right.
those out, and suddenly you got $200 pretty fast if you're feeding 3 or 4 little monsters. But otherwise, you just need to be in touch with your loan person. Hey, what's going on in the market? Where would my rate be right now? And I always encourage my people to send. You get interested in something, send me a listing. I'll work the numbers up for you, because a listing, I know what the taxes are, and sometimes we might have a bad surprise in the interest rate, but we have a good surprise in taxes. It's a complete wash, and your payment is the same. So, communication, communicate.
Every time, man. Every time. All right. Hope you guys enjoyed it. Zach, thanks for hanging out. Check us out on the
Yep.
socials, YouTube, Instagram, Facebook. Zach Jones Loans, Mortgage Your Dad Chad. Like, comment, subscribe, download, share, DM, hit the bell, follow, whatever you got. You've heard it all by now. Go back on the channel. This is 46. There's 45 other episodes. We talk about all kinds of things, ranging from dissecting deals, mortgage math, things that take place during the process, news events, current events, election stuff from the last couple of weeks that may or may not have been suppressed on these channels. But we got all those things. So help us out, help the audience grow, share it with somebody. It would mean a lot. For Zach, I'm Chad. Thanks for hanging out with us, and we'll catch you next week. Take care.
Thanks a bunch.